Lease the wrong space and you're stuck. Buy the wrong building and you own that problem. Let's make sure you don't do either. Most people think this is a math decision and it's not. If you're looking at industrial space in Burlington right now, you've got more options than you did just a year ago. You can buy, you can lease, which sounds great until you realize both can look right on paper and fail in reality. People run the numbers, compare the lease rates to mortgage payments, and think they've made that smart decision until the space doesn't work. The building limits their business or the deal stops making sense just 6 months in. I'm Susan, that commercial realtor. I work with industrial tenants, buyers, and investors across Burlington and the GTA. We structure deals that hold up in the real world. If you're evaluating industrial real estate in Burlington or Halton, this isn't about what looks cheaper today. It's about what works for your business 3 years from now. For a few years, this wasn't even a real conversation. Prices were so aggressive that even with the lower interest rates, most buyers could not make those numbers work. Leasing became the default, not the strategy. And that shifted. Vacancy across Burlington and Halton has eased into that 4 to 6% range. Lease rates have leveled after years of steady increases, generally sitting between $15 and $20 per square foot net, which all depends on quality and access. At the same time, more ownership opportunities are staying on the market longer, giving businesses time to compare options. So now both are back on the table, leasing and buying. The key is understanding that they're not interchangeable. Leasing gives you flexibility. That's the headline. In practice, it means adjusting your footprint as your operation scales, preserving capital for business growth rather than tying it up in real estate, shifting certain risks, major repairs, structural issues, back to the landlord. This all sounds clean, and it's not always. Because now you're also dealing with renewal risk, market rate exposure, landlord control over key operational decisions, fit-up costs in space that you don't own. You can build out the perfect facility and still not control your long-term occupancy. You're not leasing space, you're leasing time. Buying gives you control over your operations, over your costs, over your future. You stop renegotiating your business every 5 years. That's the upside. The trade-off, you take on capital commitment, market risk, exit risk, responsibility for the asset. In industrial space, function drives value far more than price per square foot. Power, clear height, shipping efficiency, flow, just to name a few. Get those right and ownership becomes an operational advantage, and, well, get them wrong and you just bought a liability. The companies thriving in this market are the ones that understood that early because their buildings supported their output, it didn't limit it. So the real decision, it's not lease versus buy, it's flexibility versus control. Which one matters more? If your business is scaling quickly, adjusting headcount, or still refining its footprint, leasing wins. If your operations are stable, predictable, and you know how much space you need long-term, buying wins. But the wrong building makes both options not great. That's where experience matters. A seasoned commercial realtor doesn't just show you what's available. We pressure test each space against how your business functions day to day. That's what helps protect your bottom line long after move-in. What people are getting wrong is they run spreadsheets, not site plans. They compare lease rates to mortgage payments and forget to check electrical capacity, truck court depth, ceiling height, zoning allowances, future expansion potential. That's how companies end up in spaces that look smart on paper, but choke growth later. The real job of a commercial realtor in Burlington isn't opening doors, it's interpreting risk through operations, because the numbers only work if the building does. Before you pick a lane, answer these 3 questions. What does your business need operationally? How much control do you actually require? Where is your business going in the next 3 to 5 years? This is the part most business owners try to solve alone and where the right advice pays for itself. Matching the strategy to the space, not the other way around, is what prevents the deal from going sideways. If you're looking at industrial space in Burlington right now, this decision isn't about chasing the best deal. It's about avoiding the wrong one. And if this helped you think differently about Burlington's industrial market, subscribe and follow and share it with someone who's making this call right now. I'm Susan, that commercial realtor, built for business, backed by data, negotiating with bite. Now that you know, what are you going to do about it?